Welcome, friends, to this edition of the live coaching classes for the paper Advanced Financial Management, Paper 2, New Scheme, CA Final Level. I, CA Ashish Gupta, Deputy Director, Board of Studies, welcomes you to you all. Now, student, in today's session, we shall see how the concept covered under the topic derivatives, that is basically related to what we have discussed in earlier classes, is financial derivative can be applied to the making financial or capital budgeting decisions. Basically, this topic is called real options. Now, student, in earlier classes, the financial derivative concept has been covered in detail, and you have seen the various how we can use the derivative, use it for hedging, for speculation, as well as how we value the derivative financial derivatives. Now, in this session, today we are covering how we can use the derivative in capital budgeting situation. So let us see. Now, student, when we talk about this derivative concept, one second. If you recall that, please recall in when we were discussing about the topic of uh, uh, capital busting in your intermediate. One second, let me. Okay, many students are saying good morning, Devraj, Mansha, and Viraj. Good morning, beta. Now, student, when we talk about derivatives, real options, first of all, what exactly real option? Let us see. Now, student, if you recall that when we were discussing the topic of capital budgeting in your intermediate level, when we were discussing this topic intermediate at your intermediate level, there was one very important point that this decision cannot be reversed. It is generally presumed that whenever we are taking any capital busting decision, it cannot be reversed back. And however, sometimes, of course, it cannot be reversed back because the duration is long and once the amount is invested. But what happens? Generally, this assumption ignores dynamics of capital budgeting. What are these dynamics? Sometimes what happens, for example, uh, yes, Mansha, these are strategic in nature. What happens? See, what are the other dynamics? Suppose if you have invested some, if you have invested in some project, okay, of course it may not be giving you a positive cash flow after some time. But what happens? It may, if you sell the or abandon the project, then it may be sold at some value. For example, if I say, sometimes what happens, a project may, or you can say something can be become outdated, can have some value, or antique have some value. So it may be possible that after passing of some time, of course the project may not be giving you the value, but of course you can sell it, then it will give you some value. Moreover, what happens, sometimes there is a very interesting option, like in option. What is, if I talk about simple option, option means choice. Okay, so uh, it means when sometime we may be given the choice to modify the project. So it may be possible that we may change the, modify the configuration of the project. So all these are what are the things, these are kind of a option that may be embedded in the project. Okay, generally these are ignored in a traditional capital budgeting decision. So here we normally what we do, we we can say that project will always have some opportunities, such as modification, one second, such as modification, abandonment, wait and watch. Okay, now in traditional capital budgeting, what happens, we have to take the we have been given the choice, either you take the project today or you reject it. Okay, no, but sometimes we may be given the choice. Okay, let us see, we may be given the choice, either we accept the project and as a date, or we may be given the choice that we may, they can accept the project after say 1 year. Now student, please note that in traditional capital budgeting, we have to say, so generally what we used to do, we used to compute the net present value as on zero date, that is on today. So here, of course, we shall compute the value, but sometimes it may be possible that today a project may not be acceptable, but it may be possible that it may be acceptable after say 1 year. So we can say we should need to wait or for the project. We can defer the implementation of that. For example, this I give you a very simple example. Just one small example I give you. For example, if I say a project requiring initial investment of rupees 1200 will give rupees 100 cash flow, cash flows annually on perpetual basis. Okay. Now, if discounting rate is 10%. Should we accept the project or not? Let us see. Okay. Now, in this case, our NPV will be cash flow divided by discounting rate minus initial investment. Accordingly, my cash flow is 100. Okay, I am dividing it by the discounting rate. My initial investment is 1200. Okay, since it is a perpetual cash flow, it will be the value of present value of cash inflows. Accordingly, the value will be minus 9. So of course, I will say I will not accept the project because it is giving the negative value. However, if I wait, however, if I wait for 1 year, okay, and discount value, say discount rate comes to 5%, okay, then what will happen? See, now this will be the positive value. Then I will say yes, I will accept the project. So we can see that we can have these dynamics in our options. Okay, wait and watch, abandon, okay, and other some like other option are also possible. Let me just do it. Expand or strategic decisions. Just we can say we will discuss it separately, or we can write and expansion. Okay, so all this will lead to our choice, will give the option, and as such we can have two type of whether we have a options in capital budgeting decision, and that is called real options. Okay, although the options can be, now next we discuss, of course we have discussed the financial options. Now question comes, financial options and financial real options are different. Yes, of course they are different. How they are different, let us see. Shruti, good morning, beta. Tanisha, good morning. Now, let us, this differences has been given in your study material also. Now, here we discuss the basis. Here the financial options. Here the real options. Okay, first is underlying. Of course, underlying assets are like stocks, bonds, okay, commodity, interest rates, etc. Okay, here underlying is projects. Okay, now student, I am writing down here differences only in words, but while you are writing answer in your study, in your examination, please write properly, proper answers. Now student, first difference is underlying in capital budget in these projects in real options are projects, whereas in financial options, these are this. So basically, we can see where are many criteria, varieties are available in the under the financial option. There is only one choice in real option. Then it comes the payoff, generally fixed. Okay, since cash flows are estimated, hence can be varied. See, in a when we talk about financial options, now, generally, what happens in like we have seen, if we are taking the forward contract, we know that if the price goes down, we can exercise our option. We can exercise our forward contract, or in options, we have a choice. We have a choice. So, of course, we know that if the price will go up by this, so we can exercise our call option. If price goes by such a certain limit, we can exercise our put option. So normally in this case, our cash flows are normally fixed. Of course, there will be profit or loss, but our cash flows are fixed. We know that if the price will this move, we will have this much of cash flows. Whereas in case of real options, since it is based on capital budgeting concept, and capital budgeting, our cash flows are even on an estimated basis. So what happens? Our cash flows can be varied. It is only based on an estimate. Okay, estimate can be varied. Actual can be varied. Next is exercise period. Okay, generally period is short and can be up to maximum 1 year. Okay, okay. Cash flow starts at the end of 1 year. Dear student, now here the cash flow starts at the end of 1 year, so it is a longer duration. Okay, next is approach. Okay, see here options are priced. Options are priced because they are needed to be the trading in the market. They are needed to be traded in the market. Okay, here They are generally valued to make decision. Of course, there will be another can be difference trading can be traded, cannot be traded. And there is no such any market where the option, of course, financial for financial option there are market, but for the real option there are no such market. So student, broadly these are the, we can say, the differences between the real option and the financial options. Now, according to the categories, we can divide the various options in the various categories. Let us see how we can divide the real options into the various categories. There can be n number of the of real options, because as per the each uniqueness of the project, they can be very real type of option. But generally, following categories are of the major categories of the real option. Option to expand, option to abandon, strategic option. Okay. Now, student, as per the nature of their decisions, we can divide into the various categories, like, or we can say, we can equate the real option with the financial options. How we can equate it? It can be equated like long call, long put, long call, and these are long call. Long call means you are buying the call option, you are buying the, here you are buying the put option, and here you are selling the, you are buying the call option. Of course, in study material, various other categories has also been given, but here are the major categories that are normally used in options. No, 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 no. What are you saying, Manisha? Actually, nothing. You are mixing. Please don't go away from the concept. Always try to understand the concept. Don't link it to the any other. Don't link it the manner you have sent the question. See, student, please note that just try to concentrate on the basics. Okay, you are going very far off. It is not like that. FDI, why here we are discussing FDI. FDI not really we have discussed till now. Here we are just saying how we making a parity between the real option and financial option, how we are equating the same only. Okay, student. So in your study material, we have given some options like that: long call, okay, right to invest, sometime at some future date, that is wait and watch. Okay, expand business, then we have given the long put, bundle the project. Okay, flexibility to divest the business. Okay, promise to sell if counterparty wants to buy. Okay, generally this is given. We have sell the option. Not really it happens really. Generally commitment to divest upon action of another party. Okay, then we can say it is a short put. In what circumstances take short put? Promise to buy if counterparty wants to sell. Okay, commitment to invest if other party counterparty so wants. So these are categories have been covered in our study material. Okay, student. Now we come to the discussion. Of course, we have given. Now question rises: what are the various methods normally we use in our discussion? Okay, as we have covered in earlier our financial option decision, we have see basically there are three methods we have discussed. One is binomial model, then it is a risk neutral model, then it is black school's model. Okay, so accordingly, what happens? How we can use these generally methods are will be used in as we use in a financial option. Of course, same methods shall be discussed in our in this real option valuation. Okay, student. Now let us. I think it will be better if we go to the assignment and discuss the question so that the various concepts relating to the real options must be clear to you. Okay, student. Now let us go to the assignment solving. Now first read the question. This question is earlier has been adopted from the our CS previous examination, earlier examination. Now, student, in this question, please read the question, then I will make you understand how exactly the real option can be applied here. Now it says Ramesh owns a plot of land on which he intends to construct the apartment unit for the sale. Number of apartment of units to be constructed by maybe either 10 or 15. The construction cost for these alternatives are estimated to be 600 and 1025 lakhs respectively. Current market price for each apartment is rupees 80 lakhs. The market price after a year apartment after a year for apartment units will be depend upon the conditions of the market. If market is buoyant, each apartment will be sold at 91 lakh. If the sluggish, the sale or the price of the share will be 75 lakh. Now determine the value of the plot of the land, assuming that the construction cost will remain the same in year one. And should the Ramesh construction, sorry, this line has been, uh, just you can write, ignore this line because earlier it was in question, but I think this is not required at all. The yearly rental per apartment is 7 lakh and the risk-free rate of interest is 11% per annum. Now, student, here we see now we are saying we have to determine the value of the vacant plot. Okay, we have to determine the value of the vacant plot. Now, student, when we determine the value of vacant plot, now suppose this value of the vacant plot will be determined by assuming by viewing as just a second. This value of the vacant plot will be determined using the concept, or we can say we can using the concept of or it is can be viewed from the from the perspective of other party. Like when we used the if you have recall that when we use the binomial model or any other risk neutral model, etc. What we do, we used to determine how much a person, like if you my point here is when we call delta, compute the delta in option valuation. So what does this delta indicates? It indicates if a seller sell one call option, then how much share he need to hold or she needs to hold or buy from the market to uh, cover up his selling position. Similarly, when we compute the value of vacant lot, we assume it from the other perspective that if instead of Ramesh, other party is interested in buying the land, okay, and then constructing the plot and selling the same, constructing the flats, units, and selling the same. From that perspective, we shall value the vacant land. So accordingly, we shall assume, we shall see, or we shall compute how much value we can derive from this project, considering the various options. Because here, see, if we have been given the option that the price will be fixed at the 80 lakh per unit, then certainly it will not have any problem for you. Now here there are two conditions. Market conditions are can be buoyant or it can be sluggish. So that's why here it comes the question of the option. Had it been the simple, then there will be no problem. We can determine the choice. But here we have been given the choice. We have been given the condition. Accordingly, the here option comes into the picture. Now, when it comes into the picture, we shall see how we can use. Here we shall use the risk neutral method. Okay, now how do you use? Let us see. First working, we shall see One second. Okay. Now there are four situation will be there. I'm just writing here. See, if I talk about market conditions, okay, here I can say if I construct 10 units, here I construct 15 units. Okay, if the market conditions are buoyant, here it is a sluggish. So I will discuss case one, here case two, case three, and case four. So I will see how much payoff will be here in each case. How much payoff will be in the each case. Now, student, let us see. Okay, let us see. We compute under the four scenarios. Here the market is buoyant. Here the market is sluggish. Okay, student. Now here I am constructing 10 units. Okay. If after, if after, one second. Sir, why risk neutral method is discussed here? Because there are two prices. Okay. Now, when we solve the question, just have patience. Shruti, beta, just have some patience. Then I will show why risk neutral method will be used. Because normally use risk method neutral method is used where the probability of the two prices are not available. So first we compute the probability. Let us see the solution. Then we will come to know. Okay. Now, if the market is buoyant, of course, 10 units will be sold at this much amount. Okay, construction cost is 600 lakh. The payoff will be rupees 300 and lakh. If the market is sluggish, each unit will be sold at 75 lakh. Okay, 10 units will be there. Okay, 600 lakh will be construction cost. Okay, and here it will be rupees 150 lakh. Okay, now next is 15 units. If we are constructing 15 units, if market is buying, okay, construction cost is this much. Our payout will be rupees 340 lakhs. Similarly, if the market is sluggish, okay, so we can see that student, if the market is buoyant, of course, our this will be our payoff will be better. If market is sluggish, of course, our this payoff will be better. Okay, Suraj, yes, yes. Payoff is a kind of a profit amount. Okay, now here the situation will be occur after 1 year. Okay, the builder who will purchase this flat, who will purchase this land, what he will say? He will say, I will not sell the flats today. He will say, I will wait for the 1 year. Okay. He will say, I will wait for the. Now he will say, should I wait for the 1 year or not? Now, the first question we have seen this. This is the condition. Now, next question comes. Should he construct the flat now or wait? Okay. Now next question comes whether he should construct the flat now or wait. Let us see how we compute the same. Present. Okay. Now if he says I construct the flat now, what happens? What will be the profit? See here as on date. As on date, there is only price is fixed and price is unit fixed is 80 lakh per unit. Accordingly, net payoff if 10 units are constructed. 1 second. Okay. So this will be the payoff. So our payoff will be So now decision comes. If he says ki I have to construct now, of course, if I have to construct now, so then how much units I have to put it. But here, student, please note that, of course, this is the 200 lakh. Here it is 175 lakh. But here we, if we see the payout, here if we see the payout here is 340 lakh. Okay, there is a possibility that the profit can be even 340 lakh. So here the builder can think, why should not I wait to sell my inventory after 1 year? Of course, I will get it constructed now, but I will wait to sell it after say 1 year. Of course, during that period, I can also have this rental amount also. Okay, this rental amount also with me. Now he will be interested in knowing what will be the probability of price rise and what will be the probability of price down. So accordingly, we can use here the risk neutral method. Now student, as on date, the price is 80 lakh. Okay. The probability of price increase is P. Price down will be of course -1. Okay. Now if I wait for 1 year and price comes out 91 lakh, of course I will get 1 year 91 lakh plus rupees 7 lakh as my rental income. Of course, at the end, my overall income will be 98 lakh. At this note, the price of the flat goes down, but I will get my same rental income. At this moment, the price will be 82 lakh. Price, or we can say our inflow will be with this much. Okay. So now when I have these values with me and my risk-free rate of return, today I am investing a flat. We can say like that. I am buying a flat at 80 lakh. Okay. Probability that I will get this income of rupees 98 lakh minus plus 1 minus P, probability that I will get this much of income. Okay. By solving the same, okay. So price rise, I expect my price, we can say the probability of price rise maybe there, and probability of Okay, so this will be my expected cash flow after 1 year because I have multiplied with the respective probabilities. So accordingly, okay, student. Yes, Mansha, you are correct. The value is 0.375. That so, student, let us revisit this question. Now you may be saying, sir, how we have arrived these values 340 lakh and 150 lakh. Student, please see the table I have drafted here. Okay, and here. Now, student, here please note very important point. Here the construction will take after 1 year. Okay, why? Because here the payouts are the more than as on date. Here if we see as on date, the cash flows is only 200 lakh and 175 lakh. So it is better if we wait. So that's why we have waited for the 1 year. Then we have computed the payoff. And here we have taken the payoff only of the land or the construction of the flats, not of the rent. So here that's why we have taken the payoff of this. Now let us discuss the next question. Ram Chemical Ram Chemical is in production line of chemicals, considering a proposal of building a new plant to produce pesticide. The present value of the new proposal is 150 crore, considering the scrap value at the end of life of the project. Since the new project Since this is a new product market, survey indicates that the following variation in the present value. If the mark favorable in the first year, PV will increase by 30 from the original estimate. Condition is sluggish. PV will decrease by the 40% in the of the original figure. In addition, Ram Chemicals has an option to abandon the project at the year and dispose it at the 100 crore. If the risk-free rate of 8%, what will be the present value of the put option? Okay, or we can say it is kind of a real option, and what will be the value of the real option? Okay, let us see decision tree payoff. Okay, student, the present value as per estimate is 150. Okay, now market is good, then our PV will increase by 30%. So it means 150. Okay, if market is sluggish, so our PV will be 90. Now, of course, if it is a okay, then we will continue. We will no problem will be there. However, here we have given the choice to abandon the project. Okay, and value is 100 payoff. Okay, the payoff is because it is said that it will be sold at a dispose of at the. Now, if we sell at 100, so of course we are losing the NPV of 90. If we abandon the project, of course we will get 100, but we will lose our NPV of 90. So our net payoff will be 10. Our net payoff will be 10. If I abandon the project 100, of course we shall lose our NPV of at 90. So our net payoff will be 10. So expected payoff will be this much. Now, Okay, now we shall compute the probability using the risk neutral method. Of course, our 8% is return minus 40%. Here it is positive 30%. Or we can say like that. Accordingly, when we solve it, we shall get value this like that. The value comes 0.6857, say 69%, or more accurately 6.86. This will be the good estimate, good estimation. Now we shall compute expected payoff. Okay, student. So this is the expected payoff after 1 year. This will be the value of abandonment option. Okay, student. So I hope it is clear to you now how we compute the use the option techniques in computer using in capital busting decisions, and that's why we call it as a real options, because here the assets are real, not the financial assets. Now coming to the next question. This question says like that: suppose MIS is considering installation of the solar electricity generating plant for the light of the staff quarters for light of the staff quarters. The plant shall cost rupees 250 crore and shall lead to a saving in electricity expenses at the current tariff by 21 lakh forever. However, with the change in the government in the state, the rate of electricity is subject to change. Accordingly, the saving electricity can be rupees 12 lakh or 35 lakh per year and forever. Assuming WACC of MIS limited is 10% and the risk-free rate of return 8%, decide whether the MCD should accept the project or wait or watch. Okay, so here student, there are two rational points. One is WACC, okay, one other is WACC and another is risk-free rate of return. Okay, this will be used to compute the probability. Please remember, this will be used to compute the probability, whereas this will be used to analyze the decision. Okay, let us see the solution. In two possible situations, we determine the NPV. Zero period. Okay, this will be the value of the saving forever. Accordingly, our NPV will be Now, assume that if we see that we should not go for the plant. So we say, okay, now after 1 year, say 1 year at the one point at after 1 year. First scenario, if price of electricity increases, okay, true. If the price of electricity goes down, one second. Okay, It will be 52%. As on date, our possibility of payoff is 250. This is minus return. Okay, student. As usual, that probability of price increase BP. I carry out on next page. Okay, here we apply the formula. Okay, okay, so probability of 1 minus this will be 3.48. So it is probability of increase. This is probability of decrease. Now we use the same in computing the expected payoff. Okay, so when we compute the expected payoff, let us see how we compute it. See, it is a probability of increase and it is a probability of decrease. Now, if our probability increase, our payoff is 350 minus 250. Okay, we can say 250 because here it says that it will cost. Student, please check the calculation. Okay, so this is expected payoff after 1 year. Present value of payoff after 1 year will be, okay, so this will be the, we can say whether he should accept the project or wait or watch. Thus, since our payoff is higher, or we can say we have an abandonment option, so we should wait and. A student here, as on day, our NPV was negative, whereas here our NPV, not only NPV, even value is positive. So we should wait and watch. We should wait and watch. Okay, student. So before we go for a break, I just see there is one query. Sir, this is type of a, normally, yes, this type of a questions can be asked in the examination. Okay. So you have to see what is expected from you. Student, please note that you have to see what is expected from you and what data has been given to you in the examination. Okay, student, we go here, we go for a small break. After coming back from the break, I shall discuss one question of the option valuation using the Black School's model. Okay, we have used our black schools model in financial option. Now here we shall see how we can it can be used for valuing the real options. Okay, student, let's have a small break. Now, before going for a break, we discussed the three questions, and now we are left only with the last question of the assignment. Now, read this question. This question is basically related to your strategic decisions because here we have to take a strategic decision. Now, see what decisions we have to take. Normally, this type of decisions are taken in the case of a pharmaceutical companies or any research and development organization where they have to invest a huge amount for some patent. Okay, let us see. ABC Limited is a pharmaceutical company possessing a patent of a drug called Adrix, a medicine for AIDS patient. Being an approach, ABC Limited holds the right to drugs and its marketing because it is a new one. The period of the patent is 15 years, after which other pharmaceutical company can produce the drugs with the same formula. It is estimated that the company shall require to incur 12.5 million for the development and marketing of the drugs. As per the survey, conducted the present value of the cash flows from the sale of the drug is expected the period 15 years shall be rupees 16.7 million. Cash flow from the previous similar type of drugs have been exhibited a variance of this. The moment this variance comes into the picture, it is very important because it is a distinguishing feature of the present value of cash flows. The current yield on treasury bond is 8. Similar 15 duration is 7.81. Determine the value of patent. Now here we have been given these values. Okay. Now student, please note that wherever the variance has been given, it is clear-cut indicator that here we shall use the Black-Scholes model. Okay. Now here let us see how we shall use the Black-Scholes model. For student, please note that here we shall use the Black-Scholes model of the dividend. Basically, we shall use here the dividend model here. We shall use here. Okay, how we compute the dividend Black-Scholes model, we shall see here. Now, accordingly, here the important term dividend will be covered here. Dividend means delay in production. Will give opportunity to others. Okay. Oh, sorry. 1 second. Now, students, sorry. Now, let us see. Let us discuss this question. Assignment question number 4 of the assignment. It says like that ABC Limited is a pharmaceutical company possessing a patent of a drug called Adrix, a medicine for the AIDS patient. Being an approach drug, ABC holds the right of the production of the drug and its marketing. The period of the patent shall be 15 years, after which other pharmaceutical company can produce the drug with the same formula. It is estimated that the company shall require to incur $12.5 million for the development of the drugs and marketing of the drugs. Survey conducted as per the survey conducted, the present value of cash flow from the selling of the drug within 15 years will be 16.75 million. 7 million. Cash flow from the previous similar type of drug exhibited a variance of this. So it means it indicates that we shall use the Black-Scholes model. Of the present case cash flows, the current yield on a treasury board of the 15 years is 7.8%. So determine the value of present. Now here we have been given the value which indicates that we can use the Black-Scholes model. Of course, here we shall use the Black-Scholes model with the dividend variation. We shall use the dividend based model, Black-Scholes model. Now here it comes why we shall use dividend. Now student, here please note that dividend is like a situation where if we delay in the production, it will give opportunity to others to introduce the drugs. Okay, it is also called a term. I just share with you a term. It is also called some case में leakage. It is also called the leakage because if the company does not come into the competition, it does not produce, then other companies can take the, as they delay the process, they can chances of losing the dividend. Okay. Accordingly, 1 second. One second. Accordingly, we shall see how we compute this dividend and law, or we can say that the cause of the loss is a loss of cash flows is will be treated as a dividend. Now, question rises how we compute this dividend. In this case, generally it is presumed that present project's present value will be dropped off roughly 1 by each year of the project. So accordingly, in the given case, the dividend will be 1 divided by n, 1 divided by 15, that is 0.667, that is 6.67%. Okay, so now let us use the Black-Scholes model. And other inputs are like spot price, the present value of cash flows, which is equal to exercise price, cost of development of formula, variance 60.28, 26.82%. Okay, or we can say it is at 27% or 0.27. Okay, more correctly. Now here the risk-free RF is given to us 7.8%, and dividend we have computed. Okay. Now we use the Black Scholes model value of all option. Okay. The formula will be say like that. The call will be S e raised to power minus dt into nd1 minus exercise price rt into nd2. Okay. Now as usual, we compute the value of d1. Here natural log spot price r minus d dividend plus 1 by 2 into standard deviation. T is time. Okay, student. Now D2, D1 minus. Okay, so these two values are with us. Accordingly, we compute the. Now we put the respective values there and compute the value of option. Student, till here, if you have any doubt, please ask me so that I can start putting up the values. One student is asking, sir, whether we can use this values variance if it is or it is a kind of a hint. Yeah, student, you are right, it is a kind of a hint that we have to use the Black Scholes model, because Black Scholes model normally case arises where the variation has been a variance kind of a given or standard deviation has been given to you in the question. Because in case of a binomial model, there are normally two possibilities are there: the price goes up, price goes down. Here where the standard deviation is here given, it is a clear cut indication that here the Black Scholes model is to be is required to be used. Okay, student. Now let us start putting up the values. Okay. Now this value will be log natural. Now, here we shall compute the values D1. Now we compute the value of D2. Okay, student. Now here ND1 has been value has been given to us. If we see the question, okay, student, not no problem. I think it has been missed out in typing in the printing. Sorry, sorry. The value is 2196. Accordingly, we put the value of patent. Okay, so we compute it. This value has been given to us. Okay, so value comes. Okay, student. So I hope now how we can use the concept of financial option in valuation model and valuing the real option or valuing the capital budgeting situations is clear to you. Now this topic is real option. This has been newly introduced in your new scheme. So my request to you student, please go through thoroughly this topic from your study material as well. In addition to that, there are some other topics like derivative mishaps, etc. So my request to you, please do also give a thorough reading to this topic because this topic is not important not only from a theoretical point of view, it is also important from practical point of view, and that will also help you to combat the situation of risk management in your organization. So with this, I think we can conclude this today's session. As usual, I always discuss with you. If you have any queries, you can contact us at this phone number or send your queries at our mobile app. So student, in the next class, we shall start with the new topic. Okay, there we then you and we will discuss other topics as well in the forthcoming classes. So with this, we come to the end of the topic of the derivative analysis and valuation. Please refer the study material thoroughly and even some questions that we are hosting on a website also. So far as in last class, I think last to last class, there one student has asked about the how to prepare for MCQs. My request to you, student, please for MCQ, you should develop your basic understanding of the concepts. Okay, the generally MCQs are related with the under testing the basic understanding of the student. Still, you have any problem? Of course, we shall have a session and we shall come out with the more publications in upcoming time. So, and of course, we shall come out with a mock test. Then there will be clear to you how you attempt the mock test, and there will be another more session for the BS success, etc. So, student, there we will discuss these in more detail. Still, you have any query? Please, you can contact us over the telephone. Okay, student. Thanks for patiently listening to our lecture and revise what we have discussed in today class. Thank you. Have a nice day. Ashok ji, हाँ session over. Okay.